Now, oil prices are surging, as we've been talking about, on the heels of these strikes by Israel. Joining us now, Will Kennedy. He's Bloomberg's senior executive editor for energy and commodities. You are seeing that Brent crude rise hold to a large degree. Ultimately, we talked a lot about the White House's response, but investors, of course, the world is watching for Iran's response. How might the oil markets respond based on what will happen over the weekend and into next week?
Yeah, that's exactly right, Sonali. Traders are going to be really looking to see what Iran does next. And key is the Strait of Hormuz, this narrow waterway that guards the entrance to the Persian Gulf, over which Iran has significant control, and about a quarter of the world's oil travels through every single day. Now, the great fear of oil markets has been that Iran, in a moment of crisis, would try and close that strait to shipping, and that could see, according to JP Morgan, oil go as high as $120 a barrel. Now, clearly, that's a worst-case scenario. We can see from current prices that that's not expected to happen right now, but I do think there are significant risks to shipping, that we may see a more low-level campaign to put pressure on the global economy from Iran by harassing shipping in and out of the Gulf, making tankers reluctant to go in, forcing up shipping rates, perhaps causing a shortage of tankers. These are the kind of risks that people will be looking for as they try and price crude into next week. It's also important to note that traders are buying protection against worst-case scenarios. We've seen a lot of activity, people buying call options out of the money just to give them that protection against real escalation here.
Well, I'm glad you brought up that JP Morgan call, because it certainly caught a lot of eyeballs this morning. They do assign their simulations a 7% probability to that worst case scenario of $130 per barrel. Their base case is still in the low to mid 60s. And this is something we're going to be talking about throughout the program. The fact that it doesn't feel like asset classes hold on to risk premium for all that long. And you think about past periods of escalation, such as this one, Will, it doesn't feel like oil has been able to hold that bid.
That's right. People buy the risk, but then the risk doesn't materialize and we lose that premium. Throughout all the troubles and escalations that we've seen in the Middle East over the last few years, we have never seen it take out any barrels of oil out of the market. Now, that could change. That could well change here, because these events seem as dramatic as any others that we've seen in recent years. But also there are risks of Iranian barrels coming out of the market in other ways. Sanctions are likely to snap back. The IAEA found Iran to be in breach of its nuclear obligations. The nuclear talks are over at this stage because of last night's action. So even if we don't get military action taking oils out of the market needs to prepare for Iranian barrels coming out of the market, which will be significant, but less significant than something around the Strait of Hormuz.